The COVID-19 pandemic, which began in late 2019, has had far-reaching effects on every aspect of life, including the financial world. From stock market volatility to unprecedented fiscal stimulus measures, the financial world has undergone dramatic changes. In this video, we will take a deeper look at the changes that look at the pre-pandemic financial environment and how it has evolved during and after the crisis. Make sure you subscribe to our channel and press the bell icon to get regular updates. Let's get started. The finance world before COVID. Before the pandemic, the global economy was experiencing relative stability and growth. Major economies like the United States, China, and the European Union were showing steady GDP growth, with unemployment rates at historic lows in many countries. Consumer confidence was high and financial markets were performing well, with stock indices regularly reaching new highs. Interest rates were generally low, a policy measure many central banks adopted after the 2008 financial crisis to stimulate economic growth. This environment of low interest rates made borrowing cheaper for consumers and businesses, fueling investment and spending. Easy credit availability led to increased home purchases, business expansions, and higher consumer spending. Meanwhile, the finance sector was undergoing significant technological transformation. Fintech innovations such as mobile banking, digital wallets, and online trading platforms were gaining popularity. Cryptocurrencies like Bitcoin were becoming more mainstream, attracting both retail and institutional investors. Blockchain technology was being explored for its potential to revolutionize financial transactions and data security. Global trade was robust, with complex supply chains linking producers and consumers across the world. Multinational corporations operated seamlessly across borders, benefiting from efficiencies in manufacturing and distribution. The World Trade Organization, WTO, reported steady growth in international trade, driven by globalization and the interconnected nature of modern economies. Investors were primarily focused on traditional assets like stocks, bonds, and real estate. The stock market was thriving, with technology and healthcare sectors particularly attractive to investors. Safe haven assets like gold were also in demand, but the overall sentiment was one of optimism and risk-taking. Diversification strategies included a mix of domestic and international investments to hedge against regional economic fluctuations. The immediate impact of COVID-19. The COVID-19 pandemic, which began in early 2020, caused unprecedented market volatility. Stock markets around the world plummeted as investors reacted to the uncertainty and potential economic fallout. For example, the S&P 500 experienced some of its fastest declines in history. Governments implemented lockdowns and social distancing measures, causing economic activity to grind to a halt and leading to a sharp contraction in GDP across many countries. In response to the economic crisis, central banks worldwide took swift action to stabilize financial markets. The Federal Reserve, European Central Bank, and other major central banks slashed interest rates to near zero levels and launched massive quantitative easing programs. These measures aim to provide liquidity to financial markets, support lending, and prevent a full-blown financial collapse. Additionally, governments introduced unprecedented fiscal stimulus packages to support their economies. In the United States, the CARES Act was enacted, providing trillions of dollars in aid to individuals, businesses, and local governments. Similar measures were taken in Europe, Asia, and other regions, including direct payments to citizens, enhanced unemployment benefits, loans and grants to businesses, and support for healthcare systems. The pandemic also led to significant changes in consumer behavior. With lockdowns in place, online shopping and digital services saw a surge in demand. E-commerce giants like Amazon experienced record sales, while traditional brick-and-mortar retailers struggled. Additionally, there was a shift towards saving as consumers faced economic uncertainty and job losses. Long-term changes in the financial landscape. The pandemic significantly accelerated the digital transformation of the financial sector, compelling institutions to rapidly adopt digital solutions to serve customers remotely. Online banking, contactless payments, and digital lending platforms quickly became essential, and fintech companies experienced substantial growth. There was a notable increase in investments in technologies such as artificial intelligence, machine learning, and blockchain to enhance efficiency and security. At the same time, remote work became the norm for many employees, leading to substantial economic shifts. This change impacted commercial real estate demand and altered the geographic distribution of the workforce. Companies reevaluated their need for office space, causing a decline in demand for commercial properties in urban centers. Meanwhile, employees began moving to areas with lower living costs, affecting local economies and real estate markets. The pandemic also exposed significant vulnerabilities in global supply chains. Disruptions from lockdowns and travel restrictions led to shortages of critical goods and raw materials. Consequently, many companies started reconsidering their reliance on global supply chains, exploring reshoring and diversification strategies to enhance resilience. This shift may have long-term implications for global trade patterns. The financial crisis brought on by the pandemic prompted investors to reassess their strategies, leading to a shift towards more conservative and diversified portfolios. Safe haven assets like gold and government bonds became more popular as investors sought stability. Additionally, there was growing interest in sustainable and socially responsible investing (SRI). Environmental, social, and governance (ESG) criteria became more prominent in investment decisions, reflecting a broader awareness of the societal and environmental impact of investments. During the pandemic, there was also a surge in retail investing, driven by factors such as increased savings, government stimulus checks, and the rise of user-friendly trading apps like Robinhood. This trend was highlighted by the GameStop saga, where retail investors coordinated on social media to drive up the stock price, challenging institutional investors and hedge funds. The rise of retail investors has introduced new dynamics and volatility into the stock market. Sector-specific impacts: banks and financial institutions faced unique challenges during the pandemic. They played a crucial role in distributing government aid and providing loans to struggling businesses. However, they also had to manage increased credit risk and potential loan defaults. The low interest rate environment squeezed profit margins, prompting banks to accelerate digital transformation efforts to cut costs and enhance customer experience. In the real estate sector, trends diverged significantly. Residential real estate saw a boom fueled by low mortgage rates and a desire for more spacious living conditions due to remote work. In contrast, commercial real estate, particularly office and retail spaces, faced declining demand. The future of commercial real estate remains uncertain as companies and workers continue to adapt to new work arrangements. The travel and hospitality industries were among the hardest hit by the pandemic. Travel restrictions and lockdowns led to a sharp decline in tourism, business travel, and hotel occupancy rates. Airlines, hotels, and restaurants faced severe financial distress, leading to layoffs and bankruptcies. As vaccination rates increase and restrictions ease, these industries began to recover, but the pace and extent of recovery varied by region. The healthcare sector was thrust into the spotlight due to the pandemic. Pharmaceutical companies raced to develop vaccines, with Pfizer-BioNTech, Moderna, and AstraZeneca among the first to receive emergency use authorizations. Telehealth services expanded rapidly as patients sought remote consultations. The pandemic highlighted the importance of healthcare infrastructure and innovation, leading to increased investment in medical research and technology. Global economic shifts. The recovery from the pandemic has been uneven across different regions and countries. Advanced economies with greater access to vaccines and resources for fiscal stimulus have generally recovered more quickly. In contrast, developing countries face more significant challenges due to limited vaccine availability and less fiscal space to support their economies. This divergence in recovery has widened existing economic disparities. Global trade experienced a temporary decline during the pandemic, but has since rebounded. However, the pandemic has prompted a reevaluation of trade policies and practices. There is increased emphasis on building resilient supply chains, with some countries adopting protectionist measures to safeguard critical industries. The geopolitical landscape has also shifted, with trade tensions between major economies, such as the US and China, continuing to influence global trade dynamics. The pandemic prompted unprecedented fiscal and monetary policy responses. Governments increased public spending to support their economies, leading to higher levels of public debt. Central banks maintained ultra-loose monetary policies to ensure liquidity and support economic recovery. As economies recover, policymakers face the challenge of balancing support for growth with the need to address rising inflation and manage debt levels. International organizations like the International Monetary Fund (IMF) and the World Bank played crucial roles in providing financial assistance and policy guidance to countries affected by the pandemic. These institutions mobilize resources to support healthcare systems, provide emergency funding, and promote economic stability. The pandemic underscored the importance of global cooperation in addressing transnational challenges. The future of finance post-COVID. After COVID, finance will keep changing with more tech. Banks and such will use more technology to make customers happy, work better, and stay safe online. New fintech stuff like blockchain and digital money will be big. Also, people will care more about investing in good stuff, like helping the planet and being fair to everyone. So the future of money looks high-tech and caring. That's all for now. Like and share the video and follow us for more informative videos. Thank you for watching.